Hello everyone, in this video we're going to be going through the topic of factoring and secured borrowing. So basically, I decided to cover this topic kind of by itself. A lot of students get confused about what is the difference between factoring and secured borrowing because they are kind of similar, but there are definitely some distinct differences between the two. And so we want to make sure that we're completely certain about what is the difference between these two topics, what are the differences, and then also what does that translate to into journal entries and things of that nature. Okay, so first, just to review, what is an accounts receivable? Well, it's an asset that represents an oral promise of a customer to pay for goods or services at some time in the future, right? For example, within 30 days from the date of the sale, right? And generally, customers would prefer to pay for the goods and services later rather than sooner to conserve cash and because of the time value of money, whereas companies would prefer to receive cash sooner as opposed to later because of the time value of money and to fund current operations, right? So kind of there's this tension that we should just note of, okay, well, companies want to get the money faster, but customers want to pay later, okay? And so there are ways for companies to speed up the collections of their accounts receivable, which means they're going to receive cash sooner. They're going to receive the cash quicker, okay? Because customers don't want to pay us, but we want to get the money, right? We've made the sale. We want to use this cash to fund our operations, okay? And so there are certain ways to speed up collections of accounts receivable. The two ones are factoring the accounts receivable, which means we sell the accounts receivable, and then we can also perform a secured borrowing transaction. Okay, so first, factoring the accounts receivable. Factoring is an outright sale of an accounts receivable to a third party, which is referred to as the factor. This third party is a factor. Okay, so generally what happens here is that we have certain companies, such as maybe like a John Deere or a Ford Motor Company or something like this, where these companies are not in the business of collecting accounts receivable, right? What they're in the business of is making sales of cars or trucks or whatever they might sell, right? And so, but what happens is a lot of times, when you're selling a car, you're selling, for John Deere, maybe they're selling some sort of tractor or some sort of equipment and such as that. Customers can't necessarily pay the full amount outright as of the current day, right, when they buy it. So they're allowed to have credit. But these companies, these John Deeres and these Ford Motor Companies, stuff like that, they don't necessarily want to just sit there and wait for the money. And so what they can do is they can sell the accounts receivable to a third party known as the factor, and the factor will just send them money, right? So the factor will basically give them a certain amount of money for the accounts receivable. Now, the accounts receivable, the factor doesn't give them the full amount of the money. They take a financing fee, and so we're going to see that. So the factor usually assesses a financing fee of a certain percentage of the total accounts receivable it buys. This is how the factor makes money in the form of interest revenue. Okay, so the factor, right? Maybe it's buying accounts receivable of $5,000. Well, maybe it says, okay, well, we're going to make you pay a financing fee of $200, so we're only going to give you $4,800. Okay, so the factor has to make money somehow, and the way that they do that is by basically giving the company that they're buying the accounts receivable from, they give them less money than the face value of the accounts receivable, which in this case is $5,000. Okay. Additionally, the factor usually retains a certain amount of accounts receivable it buys for future adjustments such as sales discounts and sales returns and allowances. We'll see that in the journal entries a little bit more, but just to note it really quickly. Okay. Then before moving on, there are two types of factoring. Okay. We have factoring without recourse and we have factoring with recourse. Okay. So what's the difference? Factoring without recourse, well, in this type of factoring, the company selling the accounts receivable is not responsible for any credit losses that the factoring company incurs with respect to the accounts receivable. So basically, once the company that sells this accounts receivable, once they've sold it, they're off the hook. They don't have to worry about it anymore in the future. Okay, they're not responsible for any credit losses that this factory company incurs. However, with recourse, factoring with recourse, the factor, in this type of factoring, the factor himself or herself or the company will not incur any bad debts on the accounts receivable it purchased because it will be reimbursed by the company that sold the accounts receivable to the factor. Meaning that now the company that sells the accounts receivable is responsible for the credit losses that the factoring company incurs with respect to the accounts receivables. Okay, so if the factor incurs bad debts, they won't actually be the one incurring the expense. The company that sold the accounts receivable initially is going to be the one that incurs the expense there. Okay, just as a note, and we'll see that in the journal entry, kind of how that works. We're going to have an extra liability when we have it with recourse versus without recourse. So we'll see how that works in just a minute. But just to get used to the terminology, that's basically what it is. Okay, so on the one hand, there's no responsibility on the people that sell it. On the other hand, the people that sell the accounts receivable do have responsibility for credit loss. Second, okay, right, so we just did first, factoring. Second, performing a secured borrowing transaction. In a secured borrowing transaction, a company goes to a bank to take out a loan and pledges or assigns its accounts receivable as collateral for the loan. Okay, and so basically, this idea of secured borrowing, okay, when we have the difference, okay, so factoring, it's an outright sale, okay, so you're getting rid of the accounts receivable. You no longer own the accounts receivable. It's not in your books. You actually credit it off. With the secured borrowing, you're also looking to get more money, right? You're also looking to get cash faster, but you're doing it in a little bit of a different way. What you're doing with secured borrowing is you're saying, okay, let's go to a bank, let's take out a loan, and then what we're going to do is that the bank's going to say to you, okay, we'll give you a loan of $100,000, but why should we loan to you, right? The bank isn't just going to straight up give you cash unless they know they're going to be able to get paid back, right? And so what you can do is you can say, okay, well, I have these accounts receivable, and I can pledge them or assign them, meaning that if the company that takes out the loan from the bank, okay, if they don't pay the bank back for that loan, then the accounts receivable that's pledged or assigned is going to be able to be collected by the bank to satisfy the loan, okay? Meaning that, okay, if a company took out a $100,000 loan and they pledge $150,000 of accounts receivable, if the company just doesn't pay this loan back to the bank, then the bank goes into this $150,000 of accounts receivable and collects as much money as they need to satisfy the debt, okay? So again, just to reiterate, pledging or assigning an accounts receivable as collateral means if the company who took out the loan does not pay off the loan, the bank can seize the accounts receivable and use it to satisfy the loan. Okay, so that's the difference. In this case, the difference between factoring and performing is that in performing secured borrowing, you still own the accounts receivable as the company who initially had it, and you're still going to keep collecting. You're still going to keep collecting money from the accounts receivable, okay, and using it to pay off the loan that you get. But in factoring, you actually get rid of the accounts receivable, okay? So that's just a quick overview, but this is where we can drill down a little bit further, okay? So this is the differences between factoring and secured borrowing. Very important, okay? This is very important, okay? The main difference between factoring and secured borrowing is whether the company that initially owns the accounts receivable still owns the accounts receivable after the transaction. And the transaction would be either factoring or secured borrowing, okay? First, for factoring, the company that initially owned the accounts receivable no longer legally owns the accounts receivable after the factoring transaction takes place, as we've talked about. This getting rid of the accounts receivable is shown in the journal entry for a factoring transaction as a credit to accounts receivable. Okay, so if we see this is just a normal, not necessarily a normal, but this is one type of factoring transaction. This would actually technically be a without recourse. We haven't looked at the examples yet, so we're not completely familiar with that. But the main thing we're looking at is this credit to accounts receivable. That's why it's highlighted. Okay, so the accounts receivable is gotten rid of. We don't own it anymore. Okay, so that means that we can't collect it anymore. It's not an asset to us anymore. Okay. However, on the secured borrowing side, the company that initially owned the accounts receivable still owns the accounts receivable after the secured borrowing transaction takes place. So the initial journal entry for a secured borrowed transaction, accounts receivable does not appear in the journal entry, right? So if we just were to look at these sort of three line items, this is the normal entry we make for secured borrowing. We will see that in just a minute, but this is the normal entry we make, okay? And there's no accounts receivable in that journal entry at all, okay? So accounts receivable doesn't go up, it doesn't go down, but the company that owned the accounts receivable initially still owns it after this initial transaction, right? And we can see because we're not crediting off accounts receivable. Okay, with secured borrowing, and we're going to see this in the journal entries, but what happens is that the company is going to take out a notes payable. Okay, they're going to pledge or assign the accounts receivable, and then what they're going to do is that as they collect the accounts receivable, they're going to just pay off the notes payable by using the funds from the accounts receivable. Okay, so let's go ahead and jump into some problems here. So we have some factoring examples. We have a with recourse, and we have without and then with recourse example. On January 1 of 2018, XYZ Company factors $100,000 of accounts receivable with ABC Company. ABC Company assessed a finance charge of 5% of the total accounts receivable and retained an amount equal to 6% of the total accounts receivable for probable adjustments. Okay, we're going to see just a minute what all these things look like in the journal entry. But just to note, again, when it says percentage of a certain number, again, we have to read it carefully, right? This is total accounts receivable, right? So this is the 100,000, percentage of 100,000. And again, this is a percentage of 100,000 for the 6%, okay? So when we're reading through these problems, just be very careful to be like, okay, it's 5% of this, or it's 3% of this, or it's 6% of whatever, right? Just make sure you're reading it carefully, okay? So I think the easiest part of these journal entries is to just credit off the accounts receivable, because they always just tell you, okay, they factor it. And again, factoring meaning selling, okay? So we're doing this from the journal entry from the perspective of XYZ, okay? And we're doing without recourse, okay? So again, when we're doing without recourse, this XYZ company does not worry about any sort of future liability that it might have for covering credit losses, okay? Like we talked about on the first page of the packet, okay? So basically, the easiest part of this journal entry is just to say, okay, accounts receivable is going out at 100,000. We must have to credit that off for 100,000. Then we can work on the other. Parts of the journal entry. Okay, the financing charge. What we do is we take 5% of 100,000. We get 5,000. And whenever we have a financing charge for the factoring, it always goes to loss on sale of receivables. Okay, that's always, it either equals the loss on the sale of receivables or it's a component part. Okay. And this time, because of the fact that we're without, it just, whenever we have without recourse, the financing charge equals the loss on the sale of receivables debit. Okay, and it's a debit because it's a loss, right? It's a loss because it's just a financing charge, right? It's kind of like interest expense, but we technically call it loss on sale of receivables here, okay? Then we have this due from factor account, okay? And that is basically the 100,000 times 6%, okay? And whenever it tells you this, they keep a certain amount for probable adjustments or something along those lines. Okay, it's going to be very clear. They generally will use that phraseology though. That's always just debited to due from factor. Okay, this due from factor account, basically what it is it's technically a receivable to XYZ company, where if in the future ABC company actually doesn't have any of these probable adjustments, which are things like sales discounts or sales returns and allowances, as we can see from the first page right here. They usually retain a certain amount of the accounts receivable for future adjustments such as sales discounts and sales returns and allowances. Okay, if the factor actually doesn't incur any sales discounts or sales returns and allowances, all right, then what happens is that later on the factor themselves, the company in this case is ABC, actually has to give the money to XYZ for $6,000. Okay, but if in the future ABC does incur, the actual sales discounts, sales returns and allowances, then the due from factor account would just be credited off. We would get rid of it. Okay. Then the cash is always just a plug. So basically you just solve for all the other numbers. This one you're given basically, these two you have to solve for, and then cash just falls out. Okay. Then we have with recourse, which is not too difficult. There's just basically one extra thing that happens. Okay, so again, we have XYZ company factoring $100,000 of accounts receivable with ABC. Again, ABC is the factor, right? They're the company that's buying the accounts receivable. ABC company assesses a financing charge of 5% again, and then 6% for the probable adjustments. Additionally, the fair value of the recourse liability on January 1 of 2018 was $10,000. Okay, now it says prepare the journal entry for XYZ with respect to this factoring transaction. Okay, the way you know it's with recourse, and again, on the exam, is it going to come out and tell you, or on a quiz, oh, this is with recourse, this is without recourse? It might, but I would assume no, right? Like generally speaking, that's going to be your job to determine whether it's with or without recourse, okay? And so the way you know is if you see this thing that says the fair value of the recourse liability was blah, 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 okay? If they tell you this, then you know for a fact it's a with recourse transaction, factoring. If you don't see that, it's without recourse, okay? It's literally that simple, okay? So that's basically what that's how you can differentiate. Let's go through this journal entry. Again, accounts receivable is the easiest one. It's literally just a credit for $100,000. Due from factor is the same amount. Again, like I said before, it doesn't change whether you have with or without recourse. Okay, it's always just the percentage, which in this case is 6%, times the thing that they tell you to multiply by, which is just total accounts receivable, right? 6% of a certain number. That number is 100,000. It's accounts receivable, so it's 6,000. The cash again is a plug. We'll do that last. The recourse liability in this case is actually $10,000. It tells us that, and it's a liability, so that means we have to credit it to increase it, right? And so the loss is changed, right? So basically, in this case, the loss is going to be, this loss should be 15,000 here. Okay, this should be 15,000 here. Okay, and the way that you solve for this loss is that you take you take this 5% of accounts receivables, that'd be 5,000, right? 5% of 100,000 is going to be $5,000, and then you just add in the recourse liability, because the recourse liability increases the loss. Okay, that's how you should think about it. The way you should think about it is, okay, what is the percentage of total accounts receivable for the financing charge? Multiply that by the total accounts receivable, and then add in your recourse liability. That will give you your loss, okay? Because the recourse liability, it basically increases your loss because you're on the hook for more stuff in the future, right? So forgive me for the typo, but it's 15,000 here, okay? And then the cash just falls out. It's $89,000, okay? Because if we did, this would be 110, and then if we subtracted away 15, subtracted away 6, we would end up with 89,000, okay? So that is the with recourse example and the without recourse example. All right. Now we're going to do a secured borrowing example, and then we're going to be done with this topic. Okay. So secured borrowing, on January 1st of 2018, XYZ company assigns $500,000 of its accounts receivable to ABC Bank as collateral for a $300,000 loan due on August 1st of 2018. Okay, so basically, just quickly, we have accounts receivable of $500,000, and we have a loan of $300,000. Okay, and generally speaking, what you're going to see in these problems is that you're going to have a loan, and the loan amount is going to be lower than the accounts receivable amount, which kind of makes sense because the accounts receivable has to at least equal the loan, right? Or else it wouldn't make sense for the bank to take that as collateral, because then, like, if the loan is not paid off and it's $300,000, well, if the accounts receivable isn't $300,000, then the bank can't get all its money back, right? So generally speaking, this accounts receivable, it's going to have to be at the very minimum equal to the loan balance, probably a little bit more in most cases, okay? Because you also do have interest, right? Okay. So then you have XYZ company will continue to collect the accounts receivable per the assignment agreement, right? That's kind of what we were talking about before. XYZ is the company that is assigning the accounts receivable. They're the one that it's getting the loan. They're going to continue to collect this accounts receivable and then just use that money collected from accounts receivable to help pay off this loan. They just need money now. That's why they're taking out a loan. But they do have accounts receivable that they can use to help pay off the loan, okay? ABC assesses a finance charge of 1% and then of a total accounts receivable, and then the interest rate is 10%, okay? So now we just basically have to prepare the journal entries for XYZ for the secured borrowing transaction. Assume that on February 1 of 2018, XYZ company collects $200,000 of its accounts receivable. Okay, so it's just telling us that they collected $200,000 on February 1st. Okay, so now we're at January 1st. Okay, this is when they actually take out the loan, right? It says on January 1st, take out the loan. So the notes payable is just going to be credited for $300,000. That's given to us, right? That's the value of the loan. Then it says that the bank assesses a 1% charge of total accounts receivable. So this will be 1% of $500,000, which gives us $5,000, right? So again, be careful. 1% of what? Is it 1% of the loan? Is it 1% of the accounts receivable? Again, just being very careful to read through the problem and see what they're telling you, okay? The cash, and then cash is the plug, okay? And whenever you have this finance charge for secured borrowing, it's a little bit different than the factoring. We use interest expense as the debit, okay? So this is basically always the journal entry. You just have to figure out the numbers. For the first initial transaction for secured borrowing, it's always debit cash, debit interest expense, credit notes payable. You just have to figure out the amounts. This one's usually given, and then the cash is a plug, so then you just solve for interest expense, okay? February 1st of 2018. Now again, this is assuming that the people that XYZ must pay the bank back monthly, okay? So we're just assuming monthly payments, basically. Assumes monthly payments. It could be anything, but we're just going to go ahead and assume that we're going to have monthly payments here, okay? So it tells us that on February 1st, the company collects cash of $200,000 from its accounts receivable, right? They collect $200,000 of accounts receivable, so cash $200,000, accounts receivable $200,000, and then they go ahead and pay off part of the loan, okay? So basically, cash is going to be $200,000, right? We're going to pay out the full amount in cash. Now we just have to determine what is going to reduce the notes payable balance, what's going to reduce interest expense, okay? And to solve for this, we basically would need to do the 10% times 1 over 12 for 1 month out of 12 times $300,000 for the loan, okay? And if we do that math, we basically should get $2,500. Okay, so this equals $2,500. That's how we solve for it. We just say interest rate times fraction of the year over 12 times the actual principal of the loan gives us interest expense. Okay, so that's what we solve for. And then the notes payable is just kind of a plug. Okay, so we're actually reducing the balance in the notes payable by $197.5, which means we only have a little bit more than $100,000 of notes payable outstanding to actually pay off still. Okay, so that's the end of this video, this topic, and I hope that was helpful.